Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
This episode is sponsored by our friends at YCharts. If you're an asset manager, you know just how important it is to stay ahead of market shifts, and that's exactly where YCharts delivers. Every month, YCharts releases fund flow reports packed with the latest data on fund flows, historical trends, and performance insights. These reports are an asset manager's go-to resource for spotting trends and benchmarking strategies, with powerful talk tracks that help guide their advisor-client conversations. In their November fund flows report, one trend stands out. Equity income ETFs are gaining momentum as advisors lean into more dynamic, non-passive strategies. With the rates shifting and a growing appetite for innovative solutions, understanding these trends could give you the edge in positioning your products and ultimately boosting your AUM growth. Grab your copy of YChart's latest fund flows report with the link in the show notes and get 20% off your initial YCharts professional subscription when you start your free YCharts trial and tell them that Meb sent you. New customers only. Happy holidays, everybody. We got an exceptional episode today. It's been almost 7 years since Mike Venuto has been on the show. Mike is the CIO, co-founder of Tidal Financial Group, an ETF platform helps you create, manage, grow your ETFs. They have over 175 ETFs with over $25 billion on the platform. What in the world? Today, we're going to talk to Mike about the state of the ETF industry. Then we're going to talk about some fun new strategies he's working on. Mike, welcome back to the show.
Meb, it's so great to be back, man. I know we were just chatting. I was just re-listened to episode 87 that we did together 7 years ago, and it's a wealth of predictions that I think people should listen today, because if we get it as right as we did 7 years ago, we gave some gems out.
Well, the one thing we didn't get right, and listeners, we'll put this in the show note links, but it's well worth a listen, because again, 2017, the one thing we didn't get right, I said, Mike, this is so much fun. Let's do this every month. And then you and I got busy, and it's been 7 years. Listeners, Mike is sort of a brother from another mother. We've been working together for many years, formally, informally. But it's funny, if you look back on that show, we had probably 500 million under management. We're now almost at 3 billion. You guys probably a billion maybe, and now you're 26. You hadn't even started the white label business. The S&P has doubled. We talked a lot about Bitcoin and crypto. That's been a 5-bagger probably. But we talked about a lot, like you mentioned, a lot of ideas in the ETF industry. Turns out all you got to do is get behind a big trend and just hang on for dear life. Is that what it feels like?
Yeah, I mean, it's funny because one thing that I also thought at the end, we were both like, S&P can't continue to just crank out double-digit returns. We said that. But we also said a lot of other things that you could augment it with. So we weren't exactly wrong. I would say that when I listened to it, that was the one thing I thought we got wrong.
Let's start with the tweet I'm going to read, and then we'll go deep in a lot of different topics. This is from our good common friend, podcast alum, Eric Balkunis, and it says, Juggernaut, IBIT, has hit the 40 billion asset mark a mere 2 weeks after hitting 30 billion in a record 211 days, annihilating previous record of 1,253 days held by IEMG. It's now top 1% of all ETFs by assets, and at 10 months old, it is bigger than all 2,800 ETFs launched in the past 10 years. Is that the most amazing stat I've heard this year? It might be. Weigh in. You've been a long-term crypto bull. We talked about it again back in 2017. What do you think about this from both a crypto perspective as well as from a product perspective?
It is absolutely amazing how quickly this has taken in assets. And it's not just them, there's a number of them. I think our other friend, Nate Geraci, he had a tweet where out of the 25 fastest growing ETFs this year, 14 were like crypto related or adjacent, right? They're either Bitcoin ETFs or some derivation of MicroStrategy. So it's been the year of adoption by institutional RIAs, things like that. It's funny, I think Yusko always said this isn't going to actually happen until BlackRock gets behind it, right? And It's actually what happened. The approval process, because we went through it for one of our clients, of working with the SEC to get these ETFs out, was completely unprecedented. They've never done anything like this. They never tried to line everybody up to the same day. They never approved a 19B4 on one day and everything launched the next day. Like, I've never seen anything. I don't want to get into the jargon, but 19B4 is just this hard process of working with the regulators to get something approved. I've never seen 10 ETFs launch the day after a 19B4 gets approved. Like, so the political will either changed or was forced. History will tell us someday, I'm sure. And now there's a way to get the access. What's amazing to me, though, is all these Bitcoin ETFs combined have an average expense ratio that's lower than the average expense ratio of all the gold ETFs. You've weighted for assets, unweighted for assets. Like, we're talking somewhere south of 20 average for the Bitcoin ETFs, north of 30 average for the gold ETFs. How did that happen? It's pretty exciting times. And I think there's a lot more to come. One of our clients just had a 19B4 approved for Bitcoin plus carbon credits in a 33 act wrapper. So that'll be coming soon. Another great client of ours, David Jacansky, who's worked for us for many years, spun out to start Quantify funds, and he partnered with Corey at Return Stack. He launched Bitcoin and gold. So $1 of BTGD gets you $1 of Bitcoin and $1 of gold, right? Like, and it's funny, Meb, I know I'm talking too much, but we said 7 years ago there's going to be these structural things, and this is exactly what that is.
The Bitcoin gold is an interesting example because I wonder, like, when you think of the Venn diagram, you got your Bitcoiners on one hand, blockheads, whatever you want to call them, say that lovingly. You got your gold bugs on the other hand. And there's definitely a Venn diagram overlap, but then there's also the people who are allocators, and they may not like either. Personally, they may just be like, you know what, these clients want this. I can't buy either of these because I don't want the career risk of them looking at their, be like, hey, oh my gosh, we own gold. Are you crazy? You own Bitcoin? You're crazy. But put a two together, it might be palatable. And so it finds a home. And I can see how the two of those would be perfect bedfellows.
Yeah, it's a hard money trade. So if you believe there's this debasement, then for $1, I get $2 of exposure in things that theoretically aren't getting debased. They are limited supply, stores of value. I'm not going to get into the merits of it all. I believe it. I'm an investor in it, but I can understand the allocation of capital. If you tried to have 5% Bitcoin and 5% gold in your portfolio, it's a hard thing to deal with statement risk. 5% in this gets you that exposure without having 10% allocated.
So let's rewind 7 years. You and I were talking. It's funny because you guys weren't known as Tidal then. You were known as Taroso. You hadn't even started the white label business, just dreams of what may come. Walk us through the last 7 years and 26 billion in assets and over 100 funds. What has been the runway? What's been the vision? And update us to where you are now. And then for those listening with the leprechaun dreams, a pot of gold at the end of a rainbow that want to do a fund, we'll get into that too. So what's happened?
On the last time we spoke, we spent a lot of time talking about this fund called TETF. It was kind of our flagship. So TETF was an ETF that tracked all the companies in the ETF industry. We thought it was the greatest idea, very meta. We thought this will give us the platform to talk from. And the performance, because I kept the index alive, was actually very good.
Listeners, I loved this fund. Loved.
We never got past 7 million. And so I would say it was one of those mistakes that we learned to pivot from that made us what we are today.
This was meant to be a public exposure to the ETF industry.
Yeah, you own Wisdom Tree, BlackRock, New York Stock Exchange, State Street, S&P Global. We still run the index. It's still on the Tidal website. So TETF we did with another white label firm, and they were fine. They did everything they said they were going to do. But we just looked at it and said, man, I wish they could help us with marketing. I wish they could help us with sales. I wish they could help us think about how to position in the market. I wish they could help us get on national accounts programs. I wish they helped us iterate and come up with better products or change it or pick the right ticker. And that's just not what they do. They were a firm that did what they did well. We saw it as, man, we could do this so much better because we were already helping people grow. We already had contracts with Direction and Robo Global and EMQQ and Global X to help them grow by doing portfolio consulting. So we said, okay, why don't we take the lesson from what we saw here and make a better white label platform? So we started working on that. At the same time, the other big change that came from TETF as a failure, I did an interview on Fox News where they asked me what could threaten the ETF industry. And I said, well, someday there's going to be blockchain traded funds. And they laughed at me. Well, about a month after that last podcast, we launched Block. It's close to $1 billion fund today. It's bounced around between 600 and 2 billion for the last 7 years. And it was the first platform ETF for Tidal. So we did it in partnership with Amplify and this gentleman named Gabriel Rojo. And it was our first foray into a successful ETF. So both of those ideas really came from the failure of TETF. And I love that pivot. Now, I wouldn't say it was that simple. Guillermo Trias, our CEO, gets a lot of credit here. Bringing over Eric Falkeis from Direction, who built a lot of US banks infrastructure and knew how to deal with boards and trust and all that. I mean, he really is the nexus of us being able to build a real white label platform. And over the last 7 years, that's really what we've been doing. We've been helping lots of people launch, grow, and operate ETFs.
Walk us through that a little bit. We can start to talk about a handful of funds and ideas and what's worked and maybe what hasn't worked. But if somebody's listening and they're like, look, I really want to launch an ETF, talk to us about like, what's the process? You've done 100 plus now. So I imagine you're a little more, I don't know if selective is the right word, but someone emails you after this. What are you going to say? How's it going to work?
So we take a very consultative approach. We don't launch everything. If somebody comes to us with an idea that we don't think is going to succeed, we're going to coach them and work with them and try and iterate with them to get to a product that we think will succeed. So that's the first thing. That's that value add of the Tidal experience. Gavin Fillmore, our CRO, actually has a product development group. I mean, how many platforms and service providers have a new product development team? That team is there for our clients. So they come to us and say, I want to do an AI ETF. And we say to them, let us show you the market. There's 17 of these, and this is the average expense ratio, and here's the market leader, and here's this, and here's that. How can we take yours and make it different? What is the story that we can put to it? Are you going to do active or passive, and why? So it's a very long process if the idea is not good. Somebody sticks to it and says, that's what I still want to do, and they have no seed, because seed makes an idea good almost automatically. It goes back to, if I've got seed and the idea is okay, well, then you've got time for it to sit in the market, not burn a hole in your pocket, and maybe hit a cycle, or you've got time to figure out that you need to change the product. ETFs change all the time. They change tickers, they change prospectuses, we sticker things, we iterate. So there's really two things that we care most about when somebody comes to us. Is it a good enough idea? And do you have seed? You don't have to have both. It's great if you have both.
When Mike says seed, listeners, it's seed assets going into the fund. Separate, and equally as important, is assets used to support the actual business. So if you launch something with no seed, you're going to be paying $250,000 a year of expenses just to keep the fund open. So you need to have, I always tell people, a minimum of 5 years of expenses to even consider launching a fund. Now, if you have 20, 30, 40, 50 million of seed capital going into the ETF, theoretically you need less on the balance sheet because that fund is automatically break even or profitable. So it's a different equation. So when you talk to people, when you say seed, does that mean 1 million, 100 million? I know more is better, but what does that mean when you're talking to them?
So the simple math is you take that 250 and you look at your expense ratio and you back into what's break even. So 50 bips is your expense ratio, break even is about 50 million. 100 bips is your expense ratio, break even is about 25 million. You want to have that soft circled, and then you want to have it hard circled before you launch, right? Because if you don't, you're writing me checks. And now I'm not keeping most of that. I'm writing those, taking that check and writing it to the stock exchanges and writing it to the index providers and writing it to the custodians and all that. We don't want that. I never want my clients to write me a check. I want to write you checks. So if you come out with 50 million to 50 bips, you're not writing us checks. That's awesome. Now you're willing to spend money on marketing. If you're spending money to keep the fund alive, the odds that we're going to convince you to pay for some Twitter spaces or get a PR firm or do things that can help the fund grow are low. So there are two things that tend to succeed nowadays. It's either a super good product that doesn't exist and is differentiated, or has seed and has the time for the cycle to come to it. It has the survivor.
Yeah, and you can't count on the regime or the market environment working in your favor. Listeners, I mean, we started this podcast talking about how US stocks have mowed down everything for 15 years. And not just everything within the US market cap has creamed everything. So if you run an equal weight fund, a inverse equal market cap fund, equal weighted, I don't even know how to say it, Phil's fund, shout out Phil, sorry. But you need to outlast or at least give it a chance to grow and compound. I think one of the benefits of having a diversified lineup like you or we do is it buffers that volatility a little bit. If you launch one fund, we often tell our friends that want to do that, that's fine. But realize you may be offsides for not just a year, but 2, 3, 4, 5, 6, 7, 8 years as well, which for a lot of people, it feels like a lifetime, a career right there.
It's very hard to stomach. This is a very asymmetric risk reward business, but the risk is capped. So you can know what your risk is in terms of being in the business of an ETF. The rewards are unlimited. So that asymmetry is beautiful. But if you're not going into it with the proper risk budget, it's a terrible, terrible feeling, which I experienced with TETF. But I learned so many things from it. And that's really what Tidal brings to the table, is that experience. We made all the mistakes, so you don't have to.
I thought it'd be fun. We could talk about a few funds, maybe as like case studies. Maybe we could even talk about the two you guys just launched on the FIRE movement. How about we start there?
Yeah, so the FIRE ETFs that we launched just recently, these ETFs fit into that realm of how Tidal helps our existing clients. So the FIRE movement is extremely interesting to me, and it resonates so much with so many things that I've seen in my life. We say things like 26 billion sounds great. We didn't cross a billion until 2018. So the first 6 years, I barely paid myself anything. And there were years where I paid myself zero. So I was almost forced into FIRE. And FIRE stands for Financial Independence, Retire Early. And it's a community that has been growing rapidly of people that just help each other achieve financial independence. It's moved a little away from retire early because to them, it seems retire early really means the freedom to do whatever I want. So most of them still have some sort of passive income or pet projects or consulting or board seats and things like that.
I think that the younger crowd's vision of retirement is different than our parents, who like work to the bone, get to my pension, and then like sip pina coladas in Cabo, like type of retirement. I feel like the under 40, under 50 crowd is probably a little more freedom. Like maybe it's FIFA, financial independence, freedom early. But FIRE, yeah, who's the Mr. Money Mustache? You got the Bogleheads. Who's kind of the FIRE, the big names out there?
There's a lot of them. It's easy to find. We've been reaching out to all of them and talking to them and trying to understand the community. I've been surprised because they're all like shocked that we're talking to them, because most of Wall Street avoids them because they're not paying for financial advisors, most of them, because they're working with each other. And most of them just buy VTI and chill. They really care about low fees. So I think they've been very much ignored. We found them because the YieldMax suite that we have, it's been a very successful suite for our clients. A lot of the YouTubers and influencers that were buying and talking about the YieldMax stuff were also talking about how they use it in retirement, right? Or as passive income and things like that. So I went down the rabbit hole of looking at this, and I started listening to all the podcasts and all the things that were in here. And I watched the documentary that was on Amazon. And then the New York Times did an article on it a few months ago. Then I got into the Reddit forum, and I'm like, wow, this community is doing financial education too. This is the community that's actually out there educating each other and saying the things that you and I aren't really allowed to say, because when we say it, it's considered marketing material, even though it's not marketing material, right? Like, so I was like, wow, this is the voice that we can talk to them. We will have this place to do it. So this is where Tidal decided to launch in 2 ETFs, one for helping them save, build wealth, which is one phase of the FIRE journey, and one that distributes a yield. They target a 4% yield, so that's what we did in the ETF. Now, these are not VTI and chill, and I don't want to stop anybody from VTI and chill. These are alternatives to it, or augmentations that people can choose to use or not choose to use. Either way, I want to have a conversation with the community on it. I'm sure when Rick Ferry looks at this, he's going to be like, you shouldn't do all that. I'm like, it's fine, Rick, you don't have to. But what we built was FIRS for FIRE savings, which is basically the permanent portfolio, which you and I have talked about many, many times. And then we built FIRI, which is an income portfolio that barbells income. We use things like the YieldMax suite combined with very low risk, low volatility funds. Here's the kicker. We're charging zero as a platform for it. So Tidal is doing this to engage with the FIRE community and to support Tidal clients. This is us giving free models out. I love the quote I got on the ETF.com article on it. It says, Mike Venuto says they will lose money on this. That's true. We are not doing this for the money. We're doing this for the benefit of Tidal clients and to engage with the FIRE community.
I know it's been early post-launch. What's the reception in the community? What are the people in the FIRE world saying so far?
I mean, everyone we've spoken to has been pretty supportive, but they do ask the questions that you expect the FIRE community to ask. Like, what are the acquired fund fees? And why shouldn't I just buy VTI? And how are you structuring this? Why is it different? Things like that. I don't see a reason for somebody who is 20 years from their retire date to really use our fund. VTI and chill is fine for that person. Our thinking is, as you get closer to your FIRE number, your date that you can say, all right, I've got my independence and I want to switch to distribution phase of our lives, we think having a more of a portion in a permanent like structure, right, a portfolio that has less volatility and way more diversified is a good solution. Now, you don't ever have to be 100%, but that's the kind of thing we're trying to bring to the table. Is most people in the FIRE community have never lived through the 1970s thing. They've never seen the prolonged downturns. It's been very easy to VTI and chill.
What do you mean prolonged downturns? Even downturns, like it's been 15 years. Talk to us about a few of your successful funds. What has worked? We talk about some things that didn't or new, et cetera. What have been some big standout successes for you guys? And if you could go back, would you have predicted these with certainty that they would have been the ones you would have bet on?
I love to start with our indie hit that we had no idea would be what it is. So as one of the first ETFs we launched was SPUS, Sharia portfolio version of the S&P 500. This was an $80 million RIA who came to us with this idea, and we thought, no way, this is going to be huge, but say they've got the seed and it's something different. It's now multiple ETFs and well over $1 billion. They've built a whole suite of Sharia compliant ETFs. They've really done an amazing job. You know how hard it is to get approved on platforms? The platforms call us about this fund. They did so many things right. I love products that become suites. That's the holy grail to the asymmetry. So, they have Sharia. They have the first Sukuk ETF as well, which is Sharia Islamic law does not like lending. So their form of fixed income is very different. It's more like a zero coupon. So it's not an interest rate. And that's done spectacular. I really love it. Actually, I've used it in our models from time to time because it has a different duration and all that. They've done a Sharia real estate portfolio. So they've turned it into a suite. I love those success stories.
Yeah. And listeners, the one-off funds are all great and well, but if you look at what Mike's talking about, if you have a new idea or concept, you can expand horizontally, vertically into different demographics. Others have done it. You mentioned this YieldMax concept where it's not just one fund, it becomes a platform.
Yeah, so YieldMax is a good one to talk through because that's an example of the client came to us with an idea. It was a good idea, And we actually filed for it, but we never launched it. But it iterated with our product development team to a massive idea. So YieldMax is essentially taking a single security, Tesla or Nvidia or MicroStrategy or Disney, and you're doing essentially a synthetic covered call and distributing the income. So these things have very high yields, and you get a lot of the upside. You don't get all of it, of the underlying security. That led to the next iteration. After we had 20 of those, we launched a fund of funds that owns all the YieldMax funds. So that becomes a feeder to every YieldMax fund having seed. Then we launched short versions. So we have Tesla and we have Crash. You're going to love these tickers. I know you're a ticker junkie. So CRSH is the short version of Tesla with a yield. We have NVDY for NVIDIA, and then we have DIPS, chips and dips, which is the short version.
But it's funny because this really goes back to when I think about this type of fund and strategy, to me, it's a trade or an exposure that makes life easier for someone. It's a trade or exposure they want, but they don't necessarily want to put on themselves. And the OG of this was DXJ. The Wisdom Tree Fund was a dollar hedged yen. So yen hedged Nikkei. And this fund went to like 15, 20 billion or something. This was a Wisdom Tree ETF. But when you wanted to place that trade, what individual or what advisor is going to E-Trade or Schwab and trying to do yen hedge Nikkei? Like nobody is, but you could buy the ETF. And so there's certain types of expressions that traders want, but they don't necessarily want to have to do it themselves. And often it involves derivatives of some form, whether it's an overlay, additional exposure, less exposure. But this is a good example of that.
Yeah, this is another one of our predictions, right? We said structural setups, right? So buffer shares was a suite. That's one of those structures. Now we've seen return stacking. Our mutual friend Corey Hofstein doing the portable alphas trades. I mean, Corey had no ETF business a year and a half ago, and he's over $1 billion. We both know how hard it is to get to $1 billion, and he's done it. So these structures really came from the second rule. So you talked about the ETF rule earlier. I think that did a lot for active management. When we were talking years ago, we didn't really talk about active. You've moved your entire suite to active now. Almost everybody who's coming to us is active. Then there was this second rule called 18F4, which is called the derivatives rule. It's complex, but it allowed for leverage. It broke up a monopoly that ProShares and Direction used to have. And it's allowed for all these single stocks. It's allowed for all these leverage. It's allowed for managed futures, things that just weren't doable before that. And it's just been a renaissance in ideas of structuring new forms of trades. Not only does it a headache for somebody to go do their own buy right on Tesla or MicroStrategy, they're not going to get the borrow rates that we get. They're not going to get the trades that we get, right? Not only do we do the synthetic covered call, we also do a call spread to capture more upside. That's a daily trade. That's massive amounts of active management that Jay at Zega and his whole team are doing. These are not trades that you can set and forget on your own. It takes an active manager. So putting it in the wrapper of the ETF and doing it as tax efficient as you can, and using the scale of what we can negotiate with Citadel and what we can negotiate with StoneX and all these places, you're not going to get that done at Interactive Brokers with your own account.
Well, I mean, this really started 50 years ago. You look at Vanguard, Jack Bogle, and others, their innovation, most investors, hey, I'm going to have 10 stocks. My broker at EF Hutton or Dean Witter is going to put me in some blue chips, and that's the way it's been forever. But the concept of pooling assets and being able to buy 500 positions, like no one was going to do that because A, commissions would have killed you, and B, trying to manage that on paying taxes and everything else is just a huge headache. So all of a sudden now, hey, can buy the Vanguard mutual fund, boom, trillions of dollars in assets. And then the next innovations, as you've seen, these various exposures, hey, you can buy foreign investments too. Well, you couldn't do that before. Like, forget about trying to go onto Fidelity and buying 100, 500 foreign stocks. You ever try to make a trade, listeners, in Colombia and Brazil or any of these places? Like, forget about it. So now you have even other ideas. I mean, whether it's tail risk, whether it's these ideas that are now packageable. Now, that doesn't mean everything should be available maybe, but at least people can pick and choose, and the product market fit of the free market gets to decide.
Yeah, and I love that all the listeners and all the people following us on Twitter keep telling us the ideas because we'll launch them. One of the funds I think YieldMax was a listener idea that came up on Twitter or on a YouTube channel.
Don't ask. Somebody's going to ask for some royalties, man.
Oh, no, I know which one it was. It's one we have filed, so I can't talk about it.
Should we do a Shark Tank episode and submit ideas and the best one gets selected and we give the winner a basis point or something? That sounds like a good idea.
I could do something like that. I don't have a problem giving up a basis point or even a scholarship for the startup fees or something like that. Or you get to ring the bell.
I'll let you figure out the legal on this idea before Elon Musk style. We just start giving out millions of dollars at rallies. If we can figure out a Shark Tank and launch it, that'd be fun alongside my old monkeys throwing darts idea. So, all right, well, let's talk about a few more. I mean, I could do this all day. This is super fun to me, and I'm sure the listeners love talking about the innovation because one of my favorite things is hearing about strategies I've never considered and strategies that raise billions of dollars. And I say, wow, that was really cool. What a great idea. Like the Sharia, like what a great idea. Good for them. They came up with something that no one else had really thought of. And sure enough, people wanted it. And so tell me some more. You guys got 100 plus to choose from, but let's get into a few more that listeners may never have heard of.
Let's talk about Gotham. If any of you know Joel Greenblatt or you don't know him, go find the little green book that beats the market. It is a must read. When I read it the first time, I said, this is an ETF. That was 20 years ago. And I started talking with his chief compliance officer, who was a good friend of mine, Rory Collins. And I was like, this has to be an ETF. Let's do this together. Well, it took me like 15 years to get him to do it, but I was right. So he's got two ETFs, GSPY and GVLU, that are long biased. And then he's got one that's SHRT, which is a short biased ETF. So let's talk about GSPY first. GVLU is the one that's like the little green.
Short's a great ticker because it also gets pronounced as shart, which is a not safe for work. My 7-year-old's probably favorite word today.
Let's start with GSPY. So GSPY is Gotham's version of the S&P. They don't say S&P because we don't want to pay licensing fees, but Gotham's version of the top 500. Actually, you know what? I think we are paying a license fee on that one. So it was the core of their mutual funds was these same 500 stocks. So they have a number of mutual funds with multiple billions in assets, and the mutual funds take the core portfolio and then do an options overlay, kind of a buffer around that core portfolio. Same core portfolio in all the mutual funds. Keep hearing about mutual fund conversion. These guys just said, let's launch an ETF and own it in our mutual funds. We'll have two forms of distribution. The mutual funds will augment the returns. So the heck with the share class stuff. They just have two different ways of getting the exposure. You can either have them do it hedged for you in multiple different ways, or you can own the long only. All the trading within the GSPY is tax efficient and it's passed on to the mutual fund holders. So that's one of those great innovations of using the structure. Short was a mutual fund. It had a bang up awesome 2022, but nobody wants to buy a short mutual fund because you're stuck with 30-day rule where you got to buy and hold it. It's things that have a short bias are the things that people want to trade. So we converted that from a mutual fund to an ETF for them. It was our first conversion. So that's just another one of those, like going through it with a great client. I mean, this is a guy who used to run a hedge fund that was like famous for it, like had a record setting year. He's obsessed with taxes, just like I am. I don't want to pay taxes that I shouldn't have. I pay taxes all day long on something that I've realized the gain on, including Dogecoin, but I don't want to pay taxes on somebody else's thing.
This is amazing, by the way, because like I consider myself, I'm an ETF issuer. We use ETFs. And here we are, we're talking. Sure enough, I followed Greenblatt Gotham for forever. He's been on the show. He's a podcast alum. And I knew he had a couple ETFs. And I did not know about the Short Strategies ETF. And that is a cool fund. It's 50% net short by being 100% long, 150% short. What a cool strategy. I would totally use this. And look, 500 episodes in, I've never heard of it. Great use of time getting to hang out with you, man. Every 7 years, we learn something. That's a fun idea. One of his original books, listeners, let me type it because I want to get the name totally right.
You too can be a stock market genius.
You can be a stock market genius. Yeah, that is one of the original classic investing books about how to really place trades. And also he's got the Value Investing Club, which is a investment community that you have to apply to get into and submit ideas. As your resident quant, I'm kind of useless because I don't have the write-ups. And also the reason I'm a quant is I'm an optimist and I read every single one of those write-ups. I think they're all good ideas. So I always told like Some Zero and Vic, I don't know what they say. They should do a crowdsourced version of their picks as well. It was like the old Marketocracy fund. Dude, does that still exist?
Uh, no.
That was like the original crowdsourced mutual fund.
Yeah, we have with SoFi something like that right now. So we have the SoFi 50, and it's an ETF that every month rebalances to the top 50 names held by other SoFi investors. So it's like invest along your peers. And it's actually a beautiful portfolio because it's very barbelled. Call it half in really, really boring stuff, Ford and GE and Berkshire Hathaway kind of stuff. And then you got the juice on the other side, right? It's MicroStrategy and Palantir. And it's just this beautiful like barbell of, I guess, I don't know if it's millennials anymore or what age group it is, but do it yourself, younger investors, what they're buying for themselves.
All right, listeners, since you mentioned Buffett, I'm going to mention three things. These are the three most amazing statistics I've heard in the last year or two. All three of these sound like a total post, false statement, but they're so mind-numbingly amazing. The first one was a quote earlier where the Bitcoin ETF is at less than a year bigger than almost 3,000 ETFs that have launched in the last 10 years. The second, as you mentioned, Buffett, was that Berkshire could decline 99% and still be beating the S&P since inception. Astonishing. And the third, as a fellow card player and game puzzle master, most mornings my son and I work on a puzzle that Mike's given us, is every time you shuffle a deck of cards, the odds are that that exact combination has never been shuffled in history by anyone before. And let that sink in, listeners. I was like, there's no way that's true. But you do 52 factorial, you end up with whatever it is, 80 quadzillion. The number gets very large very quick. But let all three of those sink in. I don't know which one's most impressive. All three of them are. So anyway, fact of the day.
You know what the full circle is? The first idea for YieldMax was Berkshire with a yield. And that's the one we haven't launched.
You should.
There's so little volatility that the yield would only be like 8%. But that led to, should we do it on more volatile stocks, right? So a covered call is just selling the volatility. And when Berkshire has so low volatility.
Or how about Berkshire, where you get exposure by selling puts at 1.2 times book? What is that where he says he's always going to buy the stock back? I don't know what it is now, 1.5, 2.
Well, a new client of ours has just filed for 2x Berkshire. So once that's listed, maybe there'll be options, and then I can do enough volatility.
Yeah, cool.
Yeah.
All right, so tell me some more.
So I brought all the hats too. I saw you wearing your hat.
We just got a shipment, listeners. Which one is that? I can't see.
This one's YieldMax. So we've talked enough about YieldMax.
We have a whole hat shelf over here, which you can't really see, listeners. The only one you can see is HODL. And up there is all the Cambria hats. And then if you guys send me one, we'll throw it on the wall of Hall of Fame. All right, which one's this?
Vets. So we just passed Veterans Day. This is one of my feel-good favorites, and it's one I own in the FIRE portfolios in the income, the FRRI. So this is a portfolio of loans to veterans. So it's mostly home loans, but it's also small business and student loan. So you're actually having an impact. Like, I think ESG has had a bad run. I think it was bad marketing, bad story, because there's no impact. This is actually loans that are going to veterans. Number two, they are more likely to pay back, but they trade exactly the same as loans to everybody else. So it's a great fixed income play. I use it for duration in the portfolio, really getting that deflation component in. And they give a portion of the profits back. It's run by a veteran-owned broker-dealer academy. They're in San Diego, and then they have an asset management arm that launched the VETS ETF, VETZ.
This is a use case that I've never understood doesn't take off more, where, not speaking specific to vets, but it's almost like not a special interest, but targeted to a specific community, a community that's passionate. And this could be so many different areas. It could, wade into charity, endowments. It could wade into whatever your affiliation may be, where there is some tangible benefit of associating. Now, the strategy has to stand on its own merit, of course, but in this case, it's a unique strategy. I don't think there's any others quite like it, is there?
No, there isn't. And that's why we got so excited when we met them, and we're like, wow, this one, you're really having an impact. That's what I like about it. There are so many of these, I chose not to buy these three things because they go against my values, you're not having an impact then. Right? Actually, you need to own those things to vote on them. I really love what Seth and team have done there with this, and it's getting institutional interest. It's another one that UBS and the bigger platforms will call us about.
And this is VETZ, almost 100 million.
Yeah.
Nice.
You know how hard it is to get to 100 million in the first 3 years. The first 3 years are critical for these clients. You get to break even in 3 years or slightly above it where you can reinvest. And like they just rang the bell the other day to celebrate Veterans Day in the fund. And they have access to so many amazing information. And it's just a great partner to have.
That's a great story and a great use case. I'm surprised because you have some of these communities and they're passionate and you tap into that. And it's an obvious partnership. And always surprised there's not more. All right, what else?
All right, so I'm looking at the other ones that we own in Fire. I'll put on the Fire hat for right now. So this is another one that goes to that 3-year rule. So Riser, RISR. So they just hit their 3-year number. Morningstar gave them the 5 stars. They're the number one unconstrained bond fund ranked by Morningstar out there. And all of a sudden, that 3-year mark hit and the flow started coming in. Now, there's nothing more unique than this one in the fixed income space that I've seen. They own, this is from Folio Beyond, they own strips from mortgage-backed securities. What that means is you're getting the dividend or the yield from the security, but you're getting negative duration because people pay back mortgages when they can. So it's got about a -10 duration. You can imagine how well that's performed in the last few years. So you take 6, 7, 8% yield from the strips, plus that -10 duration. This has been a monster, and it's now finally getting recognized because it came up on everybody's screen because it survived the 3 years.
The crazy thing in my mind, and so this traditionally will do best in what scenario?
It does the best when interest rates are going up. That's why it's riser. When interest rates are going down, you're going to take a little bit of a hit as long as it's not going down super fast. That 8% dividend offsets it. When interest rates are flat, it does great.
So you have some funds I put in the innovative fund category too. Nancy and what's the other one? Cruz?
Cruz, KRUZ.
Hard to remember even your own tickers at this point. I was joking before, and we'll have to put this in the show notes. One of my single favorite social media videos is, I have a couple posts. Like the fact that sitting congressmen can trade stocks is probably the most universally held belief across individual citizens as being absolutely crazy and corrupt. Like, why in God's name should they be able to trade stocks with their inside information? It's nuts. And there's a video of Dave Chappelle, comedian, and then it overlays it with Pelosi where someone asked her about trading stocks and she's like, what? I can't hear you, and just like leaves the conference room. We'll put it in the show note links. Chappelle does the same thing. It's really, really funny. Talk to us about these funds. What are they doing?
So the client here is a company called Subversive, and they partnered with Unusual Whales to parcel out the data. So the data is public disclosure. Anybody can go get it. The problem is it looks like gobbledygook. It's not like they're putting a lot of effort into making this usable data. So Unusual Whales helps out with, really partialing through the data. Then that data is sent over to Tidal. We have also as a service here, active portfolio managers. So Dan Weisskopf spends a lot of time poking through the data to try and find the patterns. And patterns are things where we know there was a committee hearing, or we know that multiple people did it at once, or like, for example, no Republican had reported buying Tesla until Marjorie Taylor Greene did it the day before the election. So like, yeah, so things like that we look for. And then the portfolio is essentially, because they're required to disclose this information, if they use inside information, it's not that they have to say they used it. They just have to tell us that they did something, right? That they traded, and that's it. Now, some of them have a broker who's just doing some direct indexing for them. We have to weed through that noise in the data. When we see 300 trades and they were all like this big, 5 shares of something, we know that's just a rebalance, right? So it's all about getting down to the nitty-gritty of what they're actually doing. And hopefully we capture some of that alpha that they're legally allowed to do. And you and I, as fiduciaries in a regulated asset management firm, would never even think of doing. But if we did, we'd go to jail. And then even like clients. I mean, Martha Stewart went to jail for what Nancy Pelosi and Marjorie Taylor Greene are allowed to do legally. And if they don't report what they did, the fine is like $250. It's more of like,
Really?
yeah. So when people are like, do you think they're going to change this rule? I was like, you know what? I think at some point they're going to make the fine bigger or the timing pre-approval or something like that. But they're never going to change this rule. They might make it better, which will give us better data to make better decisions from. But the Stock Act is not going to go away.
It likens back to the old days. I remember there used to be a mutual fund that would invest based on was Congress in or out of session. And when Congress is out of session, it actually, I think it was much better returns. When it's in session, you don't want it. I can't remember it, but it's a very simple model. I haven't looked at it in many years.
A couple other things that have been cool this year. Conversions. So we did a 351. I know you've been working a lot in this space for Rockefeller Asset Management.
It's a big name people recognize.
Yeah.
What was their concept there? What did they want to do? Was it their own clients?
Yeah, it was their own clients and it was LPs. So it's just structural alpha. The ETF wrapper is a better solution for taxable investors. We don't get to guarantee anything, but I can guarantee that an equity strategy managed in a mutual fund that's very active will be better for a taxable investor in the structure of an ETF. That's it. It's that simple. Then when you throw the 351 in, that you're allowed to do this without having to realize existing gains. When you sell the ETF in the future, you will realize a gain, but you're able to switch from an inefficient vehicle to an efficient vehicle in this structure. It's just a game changer.
Now that you've done it a few times, you have the template there. Are you starting to have a number of conversations with advisors who are like, oh, this is a no-brainer. I can wrap up all these client accounts or these private funds or mutual funds into an ETF? Is that a sort of increasing, is that going to be a 2025 dam breaking sort of concept where these mutual funds really start moving en masse? Or how does this look to you?
I don't know yet. I don't know if you and I have hit the jackpot with these or it's going to be a couple more years. And the reason I say I don't know is although the clients are starting to understand it and want to do it, there's a whole bunch of other roadblocks. So it depends on which custodian they're using. So if I'm an RIA and I'm using Schwab and Fidelity, well, Schwab might make this easy the day you want to convert it, and Fidelity might make it hard. I'm not saying bad things about Fidelity or Schwab. I don't know. You and I talked about this when we were in Chicago. I've gotten to the altar on 351s like 10, 12 times, and we've just finished 2 of them, right? And it's because...
Well, it's a lot of work. That's why.
Yeah, it's a lot of work. It's a lot of work. And there's all these other people with their hands in the cookie jar that don't have an incentive to help you get this done. It's the custodian that the assets are leaving or the lawyers from the other place. It's the same with mutual fund conversions.
If you and I could do a show where we just kind of talk about a lot of the maligned incentives of the traditional asset management world and the amount of people that middlemen who have these crazy fees where in gates, sometimes people say things out loud where my response is, did you just really say that out loud? Like we had one this year, in the last couple of months, it was a big Zoom call and the person goes, I'm just confused. How are we going to get paid on this? And I was like, what do you mean? Like this, do you want me to send you a Bitcoin drive? Like, what are you talking about? This is extremely shady that you just even requested this. It's very bizarre. They're so used, like the mutual fund historical model has been one where everyone takes a fat cut, which is why on average, the average fee is $125, right? It's because Schwab Marketplace takes a fee, person who sells the fund, the advisor, on and on. It's just a million fees, and ETFs are exchange traded. So you got Vanguard. It's a crazy world. The good news is
that's why we're seeing it.
Internet disinfectant. So
if I'm a mutual fund manager charging 100 bips, we'll say 125, I can launch an ETF at 60 and basically make the same amount of money. Not because the ETF is that much cheaper to run. It's because there's not all the other hands in the cookie jar. There's not these 12B1 fees. And it seems like the platforms are trying to find ways to extract from the ETF issuers now, but it's certainly not at the same level that the 12B1 fees were. When I was at Horizon Kinetics, we had mutual funds, and we still work with Guyad on the ATAC mutual fund. Some of these fees are 38 basis points. Some of them are more than the fund makes, because when you're below a certain level, let's say you're at 75 million, but these platforms have minimum fees, which could be more than the overall expense ratio. So then you have to decide, do I stay on this platform or do I give up? And then how do you get more assets into a mutual fund? Because mutual funds are not available where new people are buying stuff. You can't buy mutual funds at Public. You can't buy them at SoFi. You can't buy them at M1 Finance. There's no mutual funds at Robinhood. The new investors are not going to buy mutual funds. Mutual funds are going to live on forever in 401k.
Yeah. Which is why the assets have maintained as long as you have bull market. The problem is bear market, when people sell, they don't go back to the traditional legacy. That's when it gets cleaned out. So you've had this tailwind of assets going up, but you've also had the headwind of investors redeeming. But it really doesn't matter until you have the bear market, right? Because then you get the redemptions come.
I wrote a paper, I think in 2015, because I was one of those downturns, that 6 months after every 10% decline, ETFs gain assets. And then Bloomberg, Vidalia Hajek, took that chart and she wrote her version of it too. But she redid the study, and Bloomberg's able to get a little more data than I can. Well, I guess I can afford data now. Every time there's a disruption and people pull out of the market, when they come back in, they go into ETFs, not into mutual funds. It's just black and white. And so like, even in our own business, when we're doing like sensitivity analysis, downturns aren't so bad for us. In fact, I've seen it with the YieldMax stuff. We get more redemptions when we go up too much. And then when we're down, they all want to buy the dip. I don't get to tell them when to buy or whatever. I just have to make sure that we're managing the portfolio as best as we possibly can for them.
It's kind of like we did last time. As we look out to the future, any other thoughts that we haven't covered today about the ETF marketplace, about individual strategies where you're like, oh man, somebody's got to launch X? Any predictions about what's going on in our world? What are your thoughts as we wind down this year, other than Bitcoin a million?
All right. So first off, ETF is the most tax efficient vehicle. I do think that there's going to be more iterations and innovation there in tax. I think what Wes did with Box is amazing. I think what you're working on with 351s is amazing. There's a lot of things that I think can be done to improve the outcome. And it's not about avoiding tax. It's avoiding taxes on somebody else's bad behavior. That I think is the key. I think every derivative trade strategy that you can imagine that's been ever done and packaged up and sold at 3% at some bank is going to be in an ETF of some sort in the next 5 years. So every RIA out there, I know many of you are listeners, gets a call from JP Morgan's rep who says, I've got Tesla upside of X with a downside of Y, and you get this guaranteed yield and da-da-da-da.
So like the traditional structured product world.
Structured products are all going into ETFs, and it's all going to be on whatever the hottest stock is at that time, and it's going to rotate. They're going to rotate from Tesla to NVIDIA to MicroStrategy to Coinbase to Apple, and then eventually they'll get to Berkshire Hathaway. I think you'll see every one of those. I think you can open up a CFA handbook and see, I think there's over 30 option strategies, iron condors and this thing and that thing, and almost every one of them will be done on the S&P and then done on the QQQ and then done on the Russell and then eventually done on single stocks and then eventually done on baskets. Crypto stocks.
If our friends at Simplify not done that already, I feel like they've done a bunch.
There's a lot of people out there innovating. Granite Shares, Rex, Roundhill, many of our clients that are finding ways. The problem is you don't know which one is going to hit because you don't know which one is going to get the zeitgeist, right? So you can't just launch 30 of these and wait for one to hit because the others look bad to the idea. So you have to iterate and you have to work with the clients to get out the ideas that are in the zeitgeist now. Distribution is going to completely change. It's why we're trying this FIRE thing and committing to it. It's going to change because one hand is being disintermediated. I don't really think the focus is always going to be on advisors. Again, that's why I'm wearing the FIRE hat today. I want to talk to the new people who are buying this stuff because the advisors care more about statement risk than doing something. So I've been pissing off some advisors lately, but that's okay. We have product for them, and then we have product that we can build for people to build their own things from. So those are 3 decent ones. I think I'm going to be right again 7 years from now, though. The growth is not going to stop, right? The ETF juggernaut is there.
I mean, the mutual fund industry, it's one of two things. Either it's someone who's older or not even older. They're just like, look, I'm just going to ride this 5, 10 years. I'm retiring soon, or it's too much work to convert it. We're just going to hang out. We'll clip our checks. The people that own this have either forgotten about it, they've died, or like somebody else has it, or they're stuck and they can't sell it because they have huge capital gains, or it's sitting in a 401k, they've just forgotten about it. And we're just going to go full ostrich style. There are the ones that will convert. And there's so many use cases where I look at some of these and, I'm saying, man, they're getting outflows. They're having to pay these distributions. They should convert and just be done with it. But
it's all those hands on the way out, man. Like when somebody comes to us, we talk to a mutual fund conversion every day, right? Brittany and her team. Number one, did you sell it through A, B, and C shares? Meaning, did you pay for the assets? If you did, when you convert, you're going to lose most of those assets because you're going to get kicked off the platform. Number two, did people directly subscribe for your ETF? If you did, when you convert to an ETF, there's no brokerage account that they hold it in. They were a direct shareholder. So in order to convert a mutual fund to an ETF, you have to get rid of all direct shareholders.
how do they get rid of them?
You have to figure out how to get to them and ask them to move it to a brokerage house so it can convert, or you have to find a way to liquidate them and send them the check. Like, it is messy. So a lot of these like really old school ones, it's really difficult for them to convert. Next, are you converting from one custodian to another? So if you are, that one that you're leaving has no incentive to make that easy. So if it's a custodian that mainly deals with mutual funds and doesn't deal with ETFs, the odds that you're going to get to convert easily are very, very low. They're going to extract legal fees and headaches and all that sort of stuff. So I'm a big proponent of do more creative things. Madison, big mutual fund group that's a client of ours, we help them launch their own trust, right? So like there's not a one size fits all solution at Tidal, right? We figure out what works for them. So we help them launch their own trust that we administer and we put the trading to launch iterations of the things that they were good at in mutual funds as ETFs. Gotham, we already had talked about. Like there's ways to unlock the money that's stuck in the mutual funds without having to pay a bunch of the old guard to get it out.
Well, I mean, the rest of the world is years behind the US on fees and a lot of these ideas. For Tidal, what's y'all's vision for the next 3-5 years? You and Guy always coming up with a lot of ideas. Is it sort of just head down, execute? I mean, 26 billion, man, my goodness. How many folks are on the team? And as you look out to the future, what do you see for you guys?
So we're 80 people now. We actually have some physical offices. We were one of those firms that when COVID hit, they're like, what's your business continuity plan? We're like, we're already doing it. 12 years, we've been kind of using Zoom. Well, we used GoToMeeting back then. We consolidated our trading desk in Chicago because we needed more of a talent pool to bring more people in. We put our operations in Milwaukee. We're going to scale those up. I think that the next 5 years, Guy and I want to be part of all the innovations. So that's why, even though we're an ETF platform, we have a product development team to help our clients build the next thing. There's no shortage of good ideas. There are no shortage of bad ideas either. So I love that we can take that crumb of an idea and turn it into something spectacular. So I think that's a big focus for Tidal right now is infrastructure, and then innovate. And the innovate really comes from Gavin and Aga and our product development team working with the biz dev team to take ideas to the next level. I love that part of the business. Tidal, when we started it was called Taroso, but we consolidated under this Tidal name. We've kept our motto all the way through. And Guy and I say this on every on-site with the team and every town hall. We do Zoom town halls every month with the whole team, and it's always bigger. At this point, I can't get everybody on one screen. We start with this statement. We're doing this for financial and creative freedom for our clients and our stakeholders. Our stakeholders are us and our families and everything. I love that for 12 years, that's been our mantra. And now I'm doing this FIRE thing that actually links back to all that. And I'm doing this FIRE thing using portfolios that I built with the idea of saving money and distributing money, which is the whole concept. So it's amazing to me how full circle everything can come.
And now we just have to launch the ETF industry ETF again to really bring it full circle and permanent portfolio.
Well, I'm getting to do perm through FIRE.
Yeah, good point. Good point.
The TETF, if I brought it back, I think I would do it active. And I do think it's probably more powerful in the private space.
Yeah, absolutely. You're not going to get the tailwinds of growth with the Death Star, BlackRock, and some of the companies that are 100 billion plus. Like you need the little guys that are doing all the disruption and fun stuff.
The index is still alive, and it's been annualizing at around 16%. The industry itself, though, has been growing closer to 20, 21%. So the public market is not reflecting the true growth that the private market is feeling. But I guess that's probably pretty common, right?
I think the IPO window is about to smash open for the next 6-8 months. That'd be my prediction. There's so many private companies that are in the queue that just have been waiting. But again, who knows? Of the predictions, I have low confidence. That's one of them.
I don't think we're going to see too many ETF companies go public, though. It's rare for asset managers to go public.
Also, it seems like everything about my worst nightmare wrapped into one. But if you get big enough, you're a $200 billion company like some of these are. You kind of have to at some point. I don't know. Maybe don't. I think we've exhausted every topic, my man. So the listeners want to launch a fund. They want to allocate. They want to brainstorm with you about all sorts of crazy ideas. What is the best way to get in touch with you and your team?
Yeah, so you go to TidalFG.com. There's this beautiful little button on there. It says build an ETF. Click it, answer a few questions. Somebody's going to call you that day. And that's going to start the conversation. And we're going to work with you to find the best way to bring your idea to market. It's that simple. For FIRE, we're at fire-etfs.com. I want to hear from the FIRE community. Even if you want to yell at me and say you don't like it, I'm hoping you like it. Help me make it better. Help me engage. So that's super important to us. We want to know what the future of wealth management looks like. I think it's more personal. It's a community, not some guy putting you into a Monte Carlo simulator.
Who has the FIRE ticker?
I think it's a public company.
It's a public company.
Yeah, it's some small cap.
There you go. Wait for them to go out of business. Mike, it's been a blast. Again, let's do this monthly instead of every 7 years. Thanks so much for joining us today.
Hey, Meb, always great to speak with you, my friend.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.